They slammed silver during a brutal downdraft. And right in the middle of the chaos, the biggest hands in the room started buying it back. A megabank appeared to cover a massive chunk of futures exposure near the lows. A major physical trust suddenly reported a huge jump in metal. Margins spiked, hedging got choked, and physical bars kept slipping out of exchange vaults like the system was bleeding inventory. And the question everyone keeps whispering is the same. Where is the metal going? And why does it look like the move happened at the exact moment the public was most scared? Welcome back. Today we're rebuilding this from the ground up, fast, clean, and without fantasy. Because some of what people are saying is anchored in observable updates, some is interpretation, and some is the internet stapling a conclusion onto a few true screenshots. But here's the point you need to understand. Even if you remove every conspiracy, even if you assume boring plumbing explains half of it, the structure of this market is still flashing stress. And stress is how regime changes begin. So let's start where we should start. What happened? During a sharp drop in silver, a major commercial footprint showed up on the futures side in size, covering, reducing, or flipping exposure when the tape looked ugly. Around the same window, a big physically backed trust reported a large increase in silver held. Tens of millions of ounces, not a little top-off. At the same time, margin requirements jumped, the cost of carrying hedges rose, and the physical side started acting clogged. Vault categories shifted, deliverable stocks looked pressured, and metal continued leaving the exchange system over time. That is the event stack. Now here's the trap. The internet wants one clean villain, one clean motive, one clean gotcha. Markets don't work like that. Markets work like plumbing, leverage, collateral, and incentives. When those four things tighten together, you get exactly the pattern you're seeing. If you want to understand what the megabanks and BRICS-aligned physical buyers may be doing to the COMEX price discovery machine, stop watching the candle and start watching the constraints. Because the chart is where they mess with your emotions. Constraints are where the truth lives. Quick favor before we go deeper. If you want more breakdowns like this, direct, mechanical, no hype, hit subscribe. Short and simple. Subscribe. All right, let's tear it open. First pressure point, margins. When volatility jumps, the exchange protects itself. Margin is collateral. It's the clearinghouse saying, if this thing whips around, we need more money on the table so nobody blows up and sticks us with the bill. And when margins rise, two things happen instantly. Leverage dies. Forced selling appears. Not because everyone changed their mind about silver overnight, but because they can't afford to carry the position anymore. This is the part most people miss. Your position can be right, and you can still get liquidated. If you can't post the extra collateral, the market doesn't care about your thesis. It closes you out anyway. Now zoom out from traders to the real world. Physical silver businesses hedge. They buy metal, sell futures against it, and manage inventory. That's how the machine stays smooth. But when margins jump, hedges become expensive to carry. Suddenly, huge amounts of cash get trapped as collateral. Cash that can't fund operations, can't turn inventory, can't breathe. That is how a paper event becomes a physical bottleneck. Because if hedging costs explode, the pipeline slows down. Refineries slow down. Fabrication slows down. Dealers widen spreads. Everyone gets conservative. And you can see tightness even if metal exists, because the system refuses to move it at the old speed. This is why violent paper drops can happen at the same time physical pressure builds. Paper collapses faster than physical can respond. Second pressure point, inventory buckets. You've heard registered and eligible. Here's the clean version. Eligible meets specs, but it's not pledged for delivery. Registered is tagged as deliverable against futures. So when registered drops, people scream, "They're out!" Sometimes that's wrong because bars can be reclassified without leaving the building. But here's the part that still matters. Reclassification tells you about intent. When an owner moves bars from registered to eligible, they're saying, "I'm not feeding deliverable supply right now." That's not neutral. That's a choice. And if you watch that choice happen repeatedly, while volatility is high and margins are rising, you are watching the system become less willing to support paper credibility. That's the heart of the COMEX tension. COMEX is liquid paper. Its power comes from liquidity, but its credibility rests on one promise. Paper can become metal if demanded. When deliverable comfort shrinks, behavior changes. Shorts feel less safe, longs feel bolder, and the delivery calendar turns into a chessboard. Third pressure point, the trust. This is where people get hypnotized. They see a big jump in reported trust holdings near a price low and imagine trucks arriving at the exact bottom. That's not usually the mechanism. These vehicles operate through creations and redemptions by authorized participants. Timing can be messy. Paperwork, settlement, and reporting can lag. So does a big reported jump prove someone magically bought the bottom? Not automatically. It could be shares created first in response to demand, with metal sourced as the chain settles. It could be metal already inside a custody network that gets allocated and counted when reporting catches up. It could be boring. But boring still requires real bars. And if tens of millions of ounces are being absorbed while deliverable categories look pressured, it means metal is being pulled into strong custody somewhere. You don't need a villain to see the constraint. Fourth pressure point, the bank footprint. If a megabank covered a huge futures position near the lows, it matters because size at ugly moments is a tell. But it doesn't automatically mean mastermind accumulation. It could be risk management. It could be delivery positioning. It could be client flow. It could be funding costs. It could even be they were forced. So treat it as a clue, not a verdict. Because the real story isn't one bank on one day. The real story is the structure that makes those moves powerful. Fifth pressure point, the international bid. This is where the BRICS conversation gets heated. You'll see talk about physical premiums in parts of Asia versus Western benchmarks. Sometimes the premium is real. Sometimes taxes, import rules, and logistics distort the headline number. So the premium alone is not proof. But if the premium persists even after reasonable adjustments, it becomes a pressure gauge. It suggests localized demand willing to pay up for physical. And when localized demand persists, metal flows. Arbitrage moves metal from where it's cheap to where it's expensive. And arbitrage is the force that punishes paper suppression. Because to exploit the gap, someone has to buy the underpriced side. Now connect the dots. Margins rise, leverage gets flushed, paper selling hits, price drops. And right when price drops, the buyers who can fund inventory, institutions, industrials, sovereign-linked pools, step in and scoop what forced sellers couldn't hold. That is not conspiracy. That is incentives. And it explains why every time silver gets punched, the physical conversation gets louder. Now here's the line you need to remember. A lower paper price is not the same thing as easier access. What if the point isn't to make silver cheap? What if the point is to make silver hard to access, while keeping the paper price tame enough that the public stays asleep? Because you can wake up in a world where the chart says one thing, but the real market says no supply. Now let's get concrete about physical. Moving millions of ounces is forklifts, security, insurance, chain of custody, and professional vaulting. There are only so many places on Earth built to do that at scale. So persistent outflows from exchange-approved vaults over months are not a meme. Even if some of it is category shifting, even if some of it is custody relocation, inventory is the buffer. When buffers shrink, volatility grows. When volatility grows, margins rise. When margins rise, leverage dies. And when leverage dies, paper price can be smashed, even while the physical market tightens. That loop is the whole game. So where is it going? Realistic buckets, other professional vaults, industrial stock parked until it's pulled into production, long-term investment hands who want bars because bars can't be margin called, and yes, potentially strategic accumulation in a world where silver is being treated more and more like a supply chain material, not a novelty metal. But don't assume the last one without signals. Watch for confirming behavior, procurement moves, incentive changes, allocation behavior, not just vibes. Now, the part people misunderstand most is delivery. When someone says huge delivery, your brain imagines bars leaving immediately. But delivery can be transfer of title, a warehouse receipt changing hands. The bar can sit until someone requests loadout. So don't get hypnotized by one delivery headline. Track the flow, track the trend. That's where pressure shows up. Now, here's the cliffhanger for the next few weeks. If volatility stays elevated and financing stays tight, who gets squeezed next? Not the person with the strongest opinion. The person with the weakest balance sheet. Which means this can repeat. Smash price, ratchet margins, flush leverage, watch metal migrate to hands that can wait. And if you repeat that cycle enough times, you build a spring. Because every forced liquidation is a transfer. And transfers don't stay quiet forever. Now here's where the COMEX story gets dangerous. COMEX sets the headline price because it's fast. Algorithms can dump paper in milliseconds without a single bar moving. That speed creates the illusion of authority. But authority is not control. Control comes from the ability to deliver. And when deliverable comfort thins, the paper game doesn't end. It gets more expensive to play. Not with fireworks, with friction. Friction looks like wider premiums, dealers refusing tight quotes, longer lead times, higher financing costs for inventory, and a weird new reality where the screen price is down, but the invoice price is up. That's a two-tier market. Paper price on one screen, physical reality on another. And two-tier markets don't have to announce themselves. They just quietly punish anyone who thinks spot is the whole truth. This is why margin hikes matter beyond trading. Margins don't just manage risk, they select winners. They select for capital. They select for patience. They select for players who can fund inventory and wait through volatility. Now put yourself in the shoes of an industrial buyer. You don't care about being right on a chart. You care about supply certainty. You care about delivery dates. You care about whether a production line stops. So if you're an industrial and you see volatility exploding, margins rising, and deliverable buckets getting thinner, you don't wait for confirmation on social media. You secure supply. You lock contracts, you build buffer. And when buyers build buffer, the buffer moves from public to private. That's the cliffhanger. Public inventory is price sensitive. It returns to market when people get scared. Private inventory is mission sensitive. It stays put because the owner needs it for continuity, or for leverage. So the more metal moves into strategic hands, the less the market gets it back on the next paper smash. Dips become accumulation events. Now bring BRICS into this the realistic way. BRICS isn't one secret buyer. It's a direction of travel. More fragmentation. More de-dollarize the plumbing. More focus on physical settlement. More strategic stockpiles. More supply chain security. In that world, metals aren't just trades. They are optionality. They are collateral outside the Western banking stack. They are insurance in a world where sanctions, export controls, and payment rails can change overnight. So when you see persistent physical premiums in parts of Asia, and when you see long-term absorption of metal, it's not crazy to suspect some demand is sovereign-linked or sovereign-adjacent. But here's the discipline. You don't need to prove the buyer's passport to understand the effect. If long-term hands absorb metal, the buffer shrinks. If the buffer shrinks, volatility rises. If volatility rises, margins rise. If margins rise, leveraged shorts become fragile. And fragile shorts are how squeezes happen. Not movie squeezes, structural squeezes, where the cost of maintaining paper exposure becomes unbearable. Now, the most misunderstood word in this whole space is delivery. A big delivery month can be a transfer of title, a warehouse receipt changing hands. The bar can sit until the new owner requests loadout. So don't get hypnotized by one delivery headline. Watch the trend. Total inventories, sustained outflows, and whether eligible actually refills registered when pressure hits. That's where physical stress reveals itself. Now let's talk about why price can still look weak while all of this is happening. Because paper is fast, physical is slow. Fast can lie temporarily, slow eventually wins. And while the market is stressed, volatility becomes a weapon. You'll see dumps that have no narrative. You'll see rips that feel like traps. The goal is to induce motion sickness, to make you abandon your framework. So here is your framework. If price drops but spreads widen, that drop is not a clean signal. If price drops but deliverable buckets remain pressured, that drop is not a clean signal. If price drops but overseas premiums persist, that drop is not a clean signal. It might be liquidation. It might be collateral mechanics. It might be paper games. The question is not, should I panic? The question is the structure loosening or tightening? Because structure is what determines the next regime. And the structure you're seeing, rising margins, thinning deliverable comfort, steady absorption into big custody pools, and louder international demand signals, looks like a market trying to transition from paper confidence to physical priority. That transition is slow, until it's sudden. One more signal matters as context, the strategic framing. When governments start labeling materials as critical, it doesn't force price tomorrow, but it changes behavior. It tells industries to plan for constraints. It tells financiers access risk exists. It nudges procurement teams toward longer contracts and larger buffers. In a tight system, A small change in procurement behavior can create a big change in flow. And that's why boring plumbing can still be explosive. If hedging stays expensive, processors stay cautious. If processors stay cautious, product availability stays tight. If availability stays tight, buyers front-run each other. If buyers front-run each other, premiums stay wide. And wide premiums are the market quietly voting that the paper price is not the full price. So the fork ahead is simple. Either volatility cools, margins relax, and the pipeline normalizes, or physical pressure keeps building until paper has to pay a higher and higher toll to ignore it. That's not a prediction. That's mechanics. And here's the uncomfortable question you should keep in your pocket. What happens if the next volatility spike triggers another margin ratchet, while inventories are already thin? That's when paper sellers discover there isn't as much depth on the bid as they thought. That's when a routine move turns into a gap. And that's when the market stops debating motives and starts paying for metal. So don't watch for a headline that says, "Game over." Watch for the day spreads refuse to compress and the dip doesn't bring metal back. Now let's talk about what you should actually watch so you don't get emotionally whipped. First, margin policy and volatility. If margins stay high, leverage stays suppressed, and paper remains vulnerable to liquidation waves. Second, the relationship between registered and eligible. Watch the slope. If registered keeps falling without meaningful refill, deliverable comfort declines. Third, trust holdings. Watch the direction over weeks. Rising trends suggest sustained demand pulling real bars into custody. Fourth, international premiums, with context. Ignore raw numbers, respect persistence. Fifth, policy and strategic signals, actions, not slogans. Now 2 questions for you, and I want real answers in the comments. Which is driving the weirdness more right now? Margin and financing stress, or genuine physical tightness? And when you see major physical vehicles report big metal additions during a sell-off, do you read that as smart accumulation or paperwork catching up? Drop your take below. And here's your final reminder, because markets love to mess with your head. Paper price can be weaponized. Physical access is a constraint. If you see price volatility paired with rising frictions, wider spreads, pressured deliverable buckets, persistent outflows, stubborn premiums, then even if the chart looks ugly, the structure underneath may be tightening. And tightening structure creates asymmetric outcomes. Not every day, but when it breaks fast. Because once the market collectively decides physical matters more than paper, the rules change. So if you want the next breakdown when the next squeeze point shows up, subscribe. And as always, this is education and analysis, not personal financial advice. You decide what fits your risk and your goals. But whatever you do, don't let a paper smash convince you the physical world changed. It didn't. The machine did.